Welcome, ladies and gentlemen. Today is July 23rd. We are getting ready for a very crazy week. I'm going to share some things with you that should be extremely exciting for everyone. Remember, I've been warning about a July 26th inflection cycle date that's coming up. That's going to be, let me take a look at my calendar real quick. That's going to be Tuesday, Wednesday of next week. So be aware. We could have something really quite large take place Tuesday, Wednesday next week, possibly within a 4 to 5 day window either way. We've had the ECB raise interest rates. We've got news out of China that seems rather distressing. We related to their real estate. Hundreds, thousands of people are refusing to pay mortgage for unfinished construction projects. And I read an article today that says it could equal trillions of yuan, Chinese yuan, over the next 4 to 6 months. This could present a very big issue. Remember, the real estate market, I've heard stories of real estate market tripling in value in China over the last 2 or 3 years. And pretty much everybody's involved in the real estate market over there. If there's some sort of a credit collapse like we had with the 2008-2009 global financial crisis in the U.S., it could lead to a very big global issue. There's lots of people involved, lots of credit involved. It could start to create a domino effect. Okay, well, let's get started. And I want to highlight a couple of things. Number one, that gold appears to have bottomed. And we'll get to that here in a minute. The market gauges have not changed except for oil, moving into a short-term bearish trend. I'll try to show you that later. Gold and silver are still short-term and long-term bearish. Oil is short-term bearish, long-term bullish. Everything else, the NASDAQ is short-term bearish, long-term bearish, and everything else is short-term bearish, long-term bullish. That includes the Dow Jones Industrial, the Transportation Index, the SPY, the YM, and the ES. Now we're moving into sideways weakening, and I want you to be aware that we had a bit of buying last week. I'm going to show you how that played out. A lot of people are trying to buy the dip right now, thinking that the bottom is in. I am going to warn you that I do not see any real bottom yet. I see a lot of weakness in the market, a lot of concerns taking place, and I think we're still in a very big transition where the Fed is likely to raise interest rates and push us into more of an extended deflationary trend. So we are not changing anything. Our bonds position is at 20%. We raised that about 2 weeks ago. Bonds are moving slightly higher. Metals we're still holding at 25%, riding out this little downturn bounce, hopefully. Stocks are at 10%. We are not allocating a lot of money into stocks, and we're keeping 45% into cash positions. In the alternate allocation level, we've got 10% stocks, 75% cash, and 15% bonds. We may add a bit more to bonds if bonds continue to move higher and we get that capitulation bottom in metals and the fear that actually could be coming. Gold is indicating a potential bottom has set up. I'll show you that in a minute. Crude oil daily turned bearish. Economic data continue to show weakening global economy. And I suspect China, Asia could become a catalyst for a big event over the next 6 months. Bonds are trending upward, and we're waiting for confirmation. U.S. and global markets seem to have reached a major pivot. Get ready for big trends. Okay, so a couple of typos there with my keyboard. Now let's go ahead and move to, let's move over here to this and show you the custom volume ratio. We had some big buying over the last, this is a weekly basis. So over the last couple of weeks, we had a lot of buying. This was one of the highest peaks since back over here in 2019. And then you can see we went through COVID here. A lot of people buying into the dips at COVID as the bottom set up. We had a number of buying, and then right here in early 2022, we had this big dip downward in the custom volume ratio, and now we've had a little bit of buying initially in February, and then we had some buying here in May, and now we've had some buying here in July, late June and July. What we're seeing here, folks, is people are trying to buy into the dip. These are the speculative traders that think that everything is fine, we're going to buy into the dip. And this was a massive amount of buying that just completely dissipated last week. We need to be cautious of another breakdown event like this. We could see an extended downward move. We're not likely to see where we're going to see a lot of selling, but we could see a dip like this. Then we could see some very low, moderate low levels like right over here. So these are people trying to buy into the dip, and I think they're going to get burned if they're not careful with stops. The U.S. to Valuations Index here is, you can see, is stalling out near this support level, this Fibonacci support level. You can see the 2017 low here. You can see we've rolled over. Now this shows us really where buyers are trying to drive trend. So you can see here we have this. Initially, the U.S. markets moved higher off of the 2016 elections, but in reality, it was a downtrend overall until we found this support, which was a change in the U.S. dollar trend, and then that started driving a very long extended trend all the way up here until basically 2020, middle of 2020, and you can see it rolled over, and it's been really dropping. So we've had now almost a year and a half, 2 years of dropping, and I'm looking at this as a bounce and a downtrend. It's really consolidating, moving lower. We have a little bounce here. This is a monthly chart, and I want you to be aware that this could change dramatically if the bottom falls out of the market or weakens. Next, we have the custom large cap index. The large cap index is stalling. You can see here it's stalling out. It's falling into a sideways channel. We are seeing downward trending. This is a deflationary downward trend cycle. You can see in these deflationary cycles, we tend to get sometimes a bit of stalling, bit of consolidation. We had this rally here in COVID, which was a stimulus rally. Now we're in a downward cycle, and it's really pretty much stalling. You can see the trending here in the RSI and the stochastics. We're getting a bit of a hook here in stochastics short term, but I'm just concerned that we may see this stall back out the rest of the year and maybe into early next year if the Fed continues to raise rates and global concerns continue to stay elevated. This is our new TT scanner image. I have to resize this a little, and we will probably get to this a little later, but the new scanner, TT scanner image on a weekly basis is showing us that we have no new triggers, a bunch of existing triggers. These ones down here have been 1 or 2 weeks. Everything else, this one's 3 weeks, this one 1 week. You can see that things are holding up okay. We'll get to this a little later. Second phase top. Okay, this is the custom U.S. to global market index, and this goes ahead and shows you how the U.S. market is holding up above what I'm calling this COVID high gap support. This is kind of a nice little support area here, whereas the global markets have contracted. And this really tells you that the U.S. markets are somewhat immune to what's going on right now. This is a buying the dip pattern, kind of like we saw right here, kind of like we saw right here. I think this is a buying the dip pattern. It's recovering slightly. It didn't like being down around this COVID high, but I think general concerns for the market are going to weaken. I urge you to watch transportation index, oil, consumer cyclicals. I think that consumers are really starting to feel the pressure, and I think housing is going to be one of the next things that turns. Okay, the next here we have the custom global asset index. The custom global asset index is stalling, as you can see here, back into this range. We had a little bit of a recovery here, but understand that this was our COVID rally, post-COVID rally. This was the peak in September 2020. You can see we stalled out over here in May, had a little bit of a recovery in the global asset valuation. This was driven mostly by housing and other assets rallying. And then you can see here right at the end of 2021, we reached another double top. It's the same type of a price peak right over here, and we've been moving lower. At this point, you can almost see the clear wave, the A, B, C, D, and now we needed an E wave down. We could see this form a base and a bottom. If we get a rotation and it stalls up in this area, This could end up being an ABC wave down, and maybe try to move a bit higher. But I really do believe that we are at a point of unwinding, particularly in Asia and China. I think it's going to spread into Eurasia, meaning Eastern and Western Europe. And I think we're really going to see an unwinding of the excess leverages that have taken place over the last 8-9 years. This is the credit expansion cycle. It always appears here as I cycle through these charts. This is gold. Gold is right now down around 1700. So this is 1840, 16. So it's down near these lows. I'm going to show you a very powerful chart here in a bit. And I want you to understand that we're in this depreciation cycle phase for gold. Gold setting up a bottom right now could be very, very important. Okay, here's the gold chart that we want to look at. This is a monthly gold cycle index chart. What I'm looking for, ladies and gentlemen, is to start to see some sort of a new high like we saw right here. So I'm looking for this to continue, maybe to trade sideways a little bit, maybe to recover, but really I'm looking for it to get above this 46, 47, 48 area right over here and break up into a new high here. That will tell us that gold is really starting to accelerate to the upside. You can see we've got a lot of big volume over here. And this was the 2015 area here where everyone kind of rolled out of gold. This was the big peaking area in 2010-11. This was the last little rally phase. We've got a lot of accumulation right over here. I need you to understand that I think that this is going to become a very solid bottom. Remember, this is monthly. So this is taking place back here in January, February, March, right in this area. And then we have April, May, June, July. What we're looking for is 46, 47 out of this, and then gold should really start to take off. Nice solid hooks with RSI and stochastics as well. Current real estate conditions. Oh boy, where do I start? Let me just explain that active listings are now at the highest level in the last 6 years. Price declines are at the highest level. Generally 94% of every piece of property on the market right now is in some sort of a price decline. We're seeing days on market almost move back to zero compared to where we were just about a year ago, way down here at minus 45, 55%. I want you to understand that this is, or minus 55 days, this means that they were selling in a matter of hours or less than 2-3 days. This means that houses are staying on the market now 25, 35 days or longer. We've eliminated this was minus 50 days down to minus 1 day right over here in the gray. This means that the market has dramatically changed. If the Fed raises interest rates again, I think everything's going to turn positive and prices are going to start to decline. Price reduction share is climbing up to new highs. That's this little line right here. It is positive. It's climbing to new highs. We could see a big sell-off in real estate, kind of like what's happening in Canada and other areas. It's just not affecting the U.S. as much right now. And then, of course, you can see price levels are actually declining. We've peaked. We've gotten to higher levels back over here, year over year, and now we're starting to decline. It would take another 4 to 6 months to move this down, potentially into the, plus 8%, plus 7%, because we've got this such a strong extended average back here. But I think overall it is going to move down into negatives. So we'll see how this plays out. Next, we have the Consumer Engagement Index. A lot of engagement last week. This is weekly. Excuse me, let me check. This is monthly. A lot of engagement, this new unique high. But I'm going to warn you, we could end up seeing these spike highs like we've seen back over here. This was 2008, 2009. This was end of 2015, early 2016. We could end up seeing one of these spikes and then things roll back on over. So we're in a downtrend. You can see we're in a downtrend here. We got a little hook here. If we do not see any capitulation and a downtrend in the global markets with consumer prices and consumer activity, particularly houses and consumer credit, we could see this weaken right back down to these levels, maybe come down to a new low. So this is intra-month. We still have another, 6 or 7 days, trading days left before the end of the month. Let's see how this plays out. But this is kind of a buying the dip mode, so we need to see how this plays out. The custom technology ratio index is what we're looking at here, holding up near support, really seeing no support, really seeing no volume here. Again, this is a monthly chart, so you're not seeing a lot of volume buying into technology right now. I think you're going to see technology continue to weaken and maybe float a bit lower down here. You can see we've got a very strong downtrend, very strong bearish stochastics indicator. We're really not seeing a whole lot of real capitulation behind this buying right now. There's not a lot of momentum over here with my custom indicators. So be aware that technology seems very, very weak. This is an older chart. This is an older chart. Okay, these are all older charts. Let me go back. And let me come into here. This is the Fangs Index. You can see as of last week, we had a nice little rally back up here, stalled back out. This is what I was warning. We're not seeing a whole lot of real volume, not seeing a lot of momentum. We had a lot of buyers buying the dip here. Then we had weakening volume down over here. We're not seeing a lot of real momentum behind this move. We are seeing a hook in RSI. We are seeing a hook in stochastics, but nothing to indicate that we are going to see a real strong upward move. We need to see a down move here. You can see we have an A, B, C potential move. They look like they're almost perfectly equal distance. My interpretation is that we could see it move a little bit higher next week before some catalyst happens. And then I think we're going to still try to move down into this area, this lower 120, 110 area, which will put us back into these COVID highs. And that's where I think we're going to see a real capitulation bottom down here. Okay, next we are going to look at the U.S. stock market index. So you can see here we had a hook in our stochastics, or RSI, hook in our stochastics, a little bit of support here, but we're still in a downtrend. We're trying to hold up across this level here. I've drawn this blue line so I can show you what's actually happening. It comes right across this gap, and we need to see how this holds out. We just moved past this Fibonacci price amplitude arc. We could stall out here and move quite a bit lower. We are seeing some upward movement. Still a series of lower lows, lower highs, lower lows, lower highs, lower low, lower high. So we would have to get above this level here in order to really see some upward movement. And I want to warn you that we're in this extended downtrend. Fed looks like it's going to raise rates. So I'm not seeing a lot of opportunity for a buy mode here. Look at the global market smart cash index, moving a little bit higher. Remember, this has just continued to move down, weaken, 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 weaken. We're way down into these COVID lows here. I think we need to get below this, call it the 140, 137 area, this level right here. I think we kind of need to get down into this level, wash out some of the excesses. And remember, central banks are trying to keep the party rolling while they're raising rates. So they're willing to, especially the European Central Bank and the U.S. Federal Reserve, they're essentially telling us that they're tightening monetary policy. What they're trying to really do is unwind excess capital out of the market and slow down inflation. So in doing so, we could move into a very extended sideways slide that doesn't show any real opportunity for a bounce. Bounces, if you're going to see a bounce in the market, you need to be prepared to get out and protect your assets very, very quickly. They're going to be extremely risky. Okay, here's our metals index. Love this chart. Love how it bounced off of this bottom here. This is a weekly chart. We need to see it continue to consolidate and rally back up into this area, back into what I call the yellow brick road, this yellow channel here. And there is a very strong seasonal, date-based, time-based pattern that tells me that this could be the bottom. I'm going to show you some other things that says we could be looking at the bottom here. So triple bottom, actually quadruple bottom here, could be an excellent opportunity for metals and miners here. Pay attention. We need to see this hold up. The rally in metals at this point would really indicate strong fear. Strong excessive fear of what's going on globally, and I think China could be, again, the catalyst. If China starts to really implode, that could be a catalyst for a big fear cycle, which could send metals and other metals higher, platinum higher, silver higher, and other assets quite a bit lower as a fallout could come into play. Okay, the Valuations Index moved a little bit higher last week. You can see we had a pretty good hook in stochastics here. We're still down near this lower level, and I expect it, like I told you, to weaken and stall back out. We've been in this downward trend since really end of 2020. I believe we're going to see valuations weaken back out, move back down here to around the 75 area, 74 area, maybe 72 area. I really think we need to get down into this lower channel, form a base, and then begin the next rally phase, especially with what's going on with central banks. Next, we have the commodity gold index, flatlining around 2, very low price range. We're not seeing any real growth, obviously, in commodities. Everything is weakened. We had a little hook here, which is stalling back out. I think commodities could weaken, and I'm really worried that oil, the move downward in oil from the 110, 114 level to the 95 level, if it breaks below 90 or say 89, it's going to tell you that the global markets and traders are concerned that the global economy is really entering into a recessionary, deflationary cycle. So if oil gets below 89, be prepared for a big downward move in the global markets. Okay, the Volatility Index moved a bit higher last week. You can see it really didn't get much above this previous high right here. I don't consider this 9 level, this 8 or 9 level, anything super positive. We do have a little hook in our RSI. We have a hook in our stochastics. We need to be very cautious with my July 26th inflection point. I think we could have a very serious problem brewing through the end of July and into early August. So I need you to be aware that we could have some very serious debt and credit market crisis, particularly Asia, China, and that could extend over here to the U.S. Selling pressure has not been overly stated here yet. Everything's been holding up above 6, like I've been saying. If we were to get into extended selling pressure, we would see this indicator move down, or this custom index move down below 6, which would indicate that we're getting very deep selling like we had back over here. So far, we don't have that. So we need to kind of be cautious. This is stalling, flattening out. We're seeing no real momentum here. We need to kind of see what happens. And I believe that's it for our charts. Yes. Now, let's come back over here. And let's move to this and show you gold. Okay, so here is gold. Let me spread this out and try to get you to see this beautiful little yellow triangle right here. This yellow triangle is typically identified at potential extreme peaks or troughs. So understand that here's the gold chart here. We had a yellow triangle warning that we may have seen a temporary bottom. We had a yellow triangle here warning that we're seeing extreme selling pressure, maybe a temporary bottom. We've had yellow triangles extensively back over here. This is telling us that we're seeing extreme extensive selling. The blue triangle here indicates that we are seeing a moderately extreme selling potential setup. So we've got this big basing setup right here. This is what this is telling us. Potential bottom, potential bottom, potential bottom. This is extreme selling pressure. Now we get one up here on the weekly chart. What this is telling me is that we're seeing an extreme selling pressure. And let me see if I can find any other. So here's more extreme selling pressure. It came in right before a bottom. Here is extreme topping pressure, extreme selling pressure right here, right before a bottom. Extreme selling pressure here, right at a bottom. You can see how important this is. We're not going to see them all the time. This is weekly, going way, way back here. We're to 2009. Let's see if there's any others. 2006. You see, they don't show up very often on a weekly chart. So we have an extreme selling pressure trigger right back over here in gold. I want to warn you that this could be it. This could be the capitulation bottom that everyone's been waiting for. And, oh, let me rephrase that. And I need you guys to understand that this double, triple bottom that's setting up right here could be the base in gold. And we need to watch what happens in silver. Now, let's take a look over here with silver. See if we have any of the same types of setups. We have them down here on the daily chart. Nothing on the weekly chart. You can see the weekly chart has gone into bearish trending here. So we're into bearish trending here. But I think we're going to get a good solid bottom here. This is the capitulation selling low. And I think now we're going to see it really change direction. Okay, the ES is, you can see, still bullish on a weekly basis, bearish on a daily basis. The NQ is bearish daily, bearish weekly, both bearish. The Dow Jones YM is bullish weekly, bearish daily. Crude oil, bearish, new bearish trigger right here, warning of a potential bottom as well. But a neutral trigger, bullish still on the weekly. So again, what we have with crude oil taking place is that a breakdown in the global economy, contractionary economy, more COVID, potentially other diseases. We could see oil weaken, kind of like we did back over in 2020 when it went to negative numbers. We could see it move back down into this consolidation range right over here. And I hate to say it, but we could see this really move back down into the $60 to $65, $70 level. So be prepared. Oil may make an aggressive move downward if some sort of contagion event takes place around July 26th. Okay, let's take a look at the transportation index. Transportation index is basing here. You can see how it's based and started to move higher, weakened a little bit on Friday. You can see it's still bullish on the weekly, bearish on the daily. We might see this hold up a little bit if we get some positive news moving into Q3 and Q4 of the U.S. markets. Generally, though, it's got a long way to go. It has to move 18 to 20% to get up into this level, and that may not still turn it bullish overall. Let's take a look at the financial sector. Financial sector is still bullish weekly, bearish daily, calling these bottoms here. I've been calling quite a few of them, so we're getting really good support down here around 30, 31. We need to see how this plays out. It's down in this channel, which goes all the way back. I'm pretty sure I drew this all the way back. Yep. From down here 2012 level. So below this channel level right here would be extreme selling. Moving down to this channel level would be normal. It would allow us a kind of a normal range of price activity, because we could come down to this 2630, call it 2830 area, and still potentially be in this upper channel. But if we break below this channel, then the financial sector could come under extreme pressure. And I don't know how much risk the financial sector has in China, but understand that if the Chinese market really starts to contract, it could affect into Australia, Malaysia, all over Asia, and into areas where the Belt Road Initiative really is. So it's going to have a global reach in the sense that Eurasia and Europe could feel it, and if Europe starts to feel it, then the U.S. is going to feel it. This time I really think China is going to be the big issue. Let's take a look down here at bonds. And yeah, I know. Okay, so here's bonds. Here's weekly bonds. Still rolling a bit higher here on a bearish trend, bearish weekly, bearish daily. I added a little extra into our bond trade simply because of what's going on with the dollar and the Fed. I believe this could be setting up a fairly solid bottom. I'm not getting us overly aggressive. I'm watching it. I just want you to be aware that we could see a fairly strong move in bonds as a protectionary safe haven. Let's take a look here at real estate. Here, wow, here's my lines from a long time ago. Look at this. It's following right along. So here we go. I drew these lines, I don't know how many weeks ago. Indicated this was a flagging formation. Expected it to break down, consolidate, and then break down even further. We are still bullish weekly, bearish daily. But yes, real estate is likely to continue to contract depending on what the Fed does. And we're just waiting on capitulation right now, some sort of a confirmed downward move. We're just not seeing a big aggressive trend after this COVID recovery. Let's take a look at Russell. Russell 2000 here is bearish weekly, bearish daily. You can see it went into bearish trending about 4, 5, 6 weeks ago. You know what? Let's take a look at VIX. Reason I wanted to highlight this with VIX here is that I wanted you to be able to see that we have gotten this elevated level in VIX. So you know what I can do? Let me go to monthly. We're not going to have a ton of monthly data. And remember, this doesn't work the same way. The rotational modeling system doesn't work with VIX the same way. But what I wanted to highlight is how before we entered into a contagion event, we got into this elevated VIX level, up into this 17 to 35, 40 level, okay? And then we entered into a massive contagion event here where VIX shot up to 96. Well, here we had COVID. We're a little bit elevated, 11 to 26, call it a little higher. We had COVID, which was a spike, ran back down here to 14, 13, and now look at VIX. VIX is over here in the 22 to 40 level. I believe we're setting up another massive contagion event, some sort of a financial crisis with the unwinding of debt. I've warned you that I think it's coming out of China, and I think that there's nothing China's going to be able to do because I think it's a massive devaluation level. I read something, an article from last year that showed that China's debt levels have increased somewhere between 500 and 1,200% over the last 4 to 5 years. So understand they've really been leveraging themselves to the hilt, chasing this never-ending rally phase in their markets. I think it's going to be a fairly ugly outcome. So now let's go back over here to my Fibonacci system and highlight this gold chart. This is a weekly gold chart. You can see the support levels that I've drawn right down here. If we do see a recovery in gold here, we're going to see it move up to the 1900 level fairly quickly within the next 3 to 4 weeks, possibly, and then potentially move quite a bit higher. You see my Fibonacci level price modeling system is predicting a base now. We haven't indicated this bottom yet. We're getting close to indicating this bottom, but we're showing 1978 and 2036 roughly, with an intermediate target level right here at this cyan level at 1824. So understand that 1824 or higher, and again, confirmation will be coming at 1798 for gold. 1798 would provide confirmation on this weekly chart. 1823, 24 roughly or higher right here would provide a decent confirmation that we're now moving back to the upside and this support level is over. Let's come back over here, take a look at the ES. These are weekly again, ladies and gentlemen, so they're going to be showing us the weekly predictions. Okay, here we go. You can see some lines that I drew last week. This is our July 26th major inflection point. This is the rotation that I expected to see happen many weeks ago down to this level. You can see we've consolidated a bit further out beyond this green support level. We ran into resistance here. This is all Fibonacci price modeling and analysis. We've come up to this resistance level. We've stalled. We haven't gotten above this green level, which is our trigger confirmation for Fibonacci upward price trend. If we stall next week and fail at this level and move back below, say, this 38.76 level, then we're going to be looking at a continued extended decline based on this flagging formation. So let me show you here. If we see this stall and move downward, my concern, ladies and gentlemen, is that we would stall down below this level right here, this purple level here, come possibly down to this level, and then we'd basically be below this channel again. And at this point, this little failed move here, this little buy the dip rally phase, now has eliminated and failed. At that point, we're looking at back down here to the 33.85 or lower, which is ultimately where I believe this bottom's going to occur. Okay, I don't want to spend too much time on all of this. I'm going to produce another video with regards to gold and with regards to China. I want you to understand that I'm trying to keep you abreast of everything that's going on. Follow my research on Twitter. Follow my videos on YouTube. We're really in a broad unwinding phase, and all of my charts are telling us, if we take a look back over here again, the technology sector is unwound down to the 2013 to 15 levels. It could get a lot worse with depreciation and with rising interest rates. The consumer engagement level bounced back up, but look at where we're at. We're way back over here to 2013-15 levels again. If we stall back out, this is the level, the 15 level here is where we've got to watch for real concern. The global asset index level is still holding up at around 2020 levels. So we haven't seen assets depreciate yet. And this is where the real concern comes in. If we get into a real deflationary cycle or some sort of a contagion event, like I'm saying with China and Asia and Europe, we could see assets wipe back out to this 2019 level. So understand that that would be from where we're at now at roughly 66 to down to 80. You need to understand that that's a 30%, 35% decline in global assets to reach the pre-COVID levels. The global market indexes, these have already shown that global assets are already below the COVID highs. But the U.S. market is dancing around above the COVID highs, and I'm thinking we need to get down into this reddish area right here, 2019, 2020, wipe out all of this excess that the Fed has created. That means we'd be looking at, again, a 25 to 30% decline back down into this area, which would put the global assets below COVID lows, meaning Europe, China, Asia, and that's where I'm really trying to warn you. We need to be very, very cautious of another breakdown event. We need to be cautious of a late July, early August kind of a catalyst event, and that's, again, where the real issue is coming in. So follow my research. Stay abreast. I'm going to be updating my website soon, making some more changes, showing you some new solutions and technology that you should be really excited about, including automated trading. And I just want you to be aware that do not get sucked into trying to buy this dip excessively. I don't believe it's going to stick around. I think it's just a fleeting little dead cat bounce. And I really believe the U.S. markets are staying immune from global risk right now, but we can't stay immune forever. We're essentially one big globally connected economy right now. Even though the U.S. dollar is stronger, and it has been stronger, it will eventually weaken because of a global contagion event. We're just waiting for it. All right, that's it for now. Talk to you later.